Welcome back to the Investing with Dana YouTube channel. And before I forget, I'd like to ask you if you would subscribe, like this video, give it a thumbs up, share it, do whatever you can do to help my channel grow, make it worth my while. I'm doing some fun stuff and I would like to share it with everybody and see what people think about it. So, this is episode 2 of the series I'm doing that will compare a rental house investment to high income ETFs. So we had a rental house, we had several rental houses, and we've sold them. And the proceeds from the one rental house, we decided to put into this Robinhood account into high yielding ETFs. And we kind of want to see how it will perform compared to if we kept the rental house. So people said to me like, "Why are you selling your rental houses? Why are you selling your rental houses?" In episode 1, I explained that, but basically they're too much management hassles, and we are retiring and don't want to have the hassles. So instead, I think we could do a whole lot better with that money in ETFs. So the house we had was paid off, so we collected the proceeds and invested in these ETFs. So let's go ahead and review what we're talking about here. So the house is worth about $70,000. The rental income, if we kept it, would be about $700 a month. Could be a little higher. We were actually getting $650 when we sold it. That was a little bit low, but I'm going to go with the numbers that we were getting for real. We'd owned this house for 8 years. We sold it in October 2024. The figures are based on previous history and the reality of everything. Over here on the right-hand column, we're going to take that money and put it into high-income ETFs. We're going to invest 70,000. The goal is to try to get 20 to 35% annually. It's a dedicated account. The money invested is from the sale of the rental. I already mentioned that. And it's real money, the real results. It's not paper trading. So let's go ahead and look at this. So this is the end of month 1. So this is, we just finished up November. It's the end of November right now, so the last of the results are in. And we have this Robinhood account, and we have margin on this account. So I'm using some margin to boost our return. Some people might say, well, that's cheating because you didn't get a home equity line of credit on your rental house and invest that separately. Well, over the years, we kind of did to buy more property, but that's a long story. So on this account, we have the 70,000 we put into it, and then I have margins. So if you look at the equity here, it says 74,165. So that's what it is worth at the end of November, at the end of this month. So we originally put in 70,000, and we have 57,000 in margin right now. Now people are going to say like margin is dangerous, and you're going to get a margin call, and you're going to lose everything, and the world's going to come to an end. So I've been around for a while. I've done things, bought real estate, been involved with the stock market. I've been around for quite a while. Nothing really scares me a whole lot. Nothing bothers me. All the things that people told me bad that would happen over the years with real estate and the stock market, it hasn't happened. If it has happened, it's recovered. So I don't worry about what people say. So enough of that. The investments I have are in the QDTE. We have $110,000 in QDTE, and then we have 20,000 in AIPI. And in future videos, I may do an in-depth video on each of those and what they are and how they work. But for now, those are the 2 ETFs that we have money into. 2,600 shares here, 400 here. So the one thing going forward that you might not see a whole lot of movement on is this average cost or this price per share. So this price per share, 42.68, and then down here 50.67. You look at the average cost is almost identical that we paid for it a month ago, but yet I invested 70,000 and my equity has grown to 74,000. So if I sold everything and pocketed it, I'd have $74,165 and some change. But down here, the price has hardly budged off what I paid for it. That's because these are income funds. They pay a very high dividend each month, and the NAV, the net asset value, kind of stays the same. It may grow a little bit, but for the most part, it stays basically the same. So let's keep moving here. So I said these pay a dividend. The QDTE fund pays a weekly dividend every Friday. The AIPI pays a monthly dividend toward the end of the month. So if you look at these dividends, start down here at the bottom. So November had 5 Fridays. So I collected an extra dividend, weekly dividend this month for QDTE. So November 1st, we received $514. On the 8th, we got 664, some change, 635, then 634, and then let's jump up here, and then November 29th, we got 574. It dropped a little bit. This one here, if you look over here, this is the AIPI. Doesn't actually have that in the name, but that's what it is. We received a monthly dividend for that one of $604. So the total, I put these into an Excel spreadsheet with the dates. The total, $3,628 for the month of November. So those are the dividends we received. So in a way, I'm comparing the dividends to rent I collected. So that's how I'm kind of comparing things. So I'm kind of comparing my rental house is worth 70,000. My fund here is worth 70,000 starting out. And the amount of money I collected for the month, I'm collecting rent on the rental house side, but on the ETF side, I'm collecting dividends. So you can see that already that maybe the dividends are going to win this month. Let's look at something else here. So before I started doing this, I wanted to do some projecting of how I think things will work out. So over here, I have dates, 11/1, 12/1. I have this highlighted yellow because this is where we're at right now, about 12/1/2024. I started out with 70,000, and then over here, I have what actually is happening. So this is the ETF I'm looking at. Both these columns are ETF. So over here is projected actual, what's happening. So what I projected, I'd start with 70,000. After the first month, I'd end up with 72,450. And then each month it would grow after that. So in about 2 years, I'm projecting if I sold everything, I'd have 165,000 in this ETF. So 2 years. So that's more than double. Actually, if I look here about July of 2026, about 139, 140,000. I'm projecting to double my money in about 18 months. Now that just seems crazy and impossible to people. And it might be, but we'll find out. I'm actually shooting for 3.5%. So when I'm earning 3.5%, this is per month. I'm not earning that on the 70,000 and the 72,000. I'm earning that 3.5% on my 70,000 plus my margin that I borrowed, which is this total over here, like 126,000. So for the month of December, I should be earning 3.5%. That's my goal on the 126,000 plus whatever dividends I earn in that month and reinvest. That should grow a little bit, not a lot, because The income funds are based on per share. So it might be like 25 cents per share for how many shares you got. So if I got 2,600 shares, I get 25 cents a share, and that's my income. It doesn't matter if it goes up $1 from the price per share goes from 42 to 43. I'm still probably just going to get the 25 cents a share. It may fluctuate a little bit, but it usually doesn't fluctuate based on the price per share. It fluctuates on how much money that fund has earned for the month by selling covered calls. And we're not going to explain covered calls in this video because it's more complicated than that. But what's not confusing is the 3.5% is based on this total of 126,000, not the 70,000. So the margin is not free. I pay 6% per year for margin. So that comes out to be about 0.5% per month for this 50 to 55,000 where I'm at right now. Actually, I'm about 57,000. So I pay 1/2 of 1% per month. The first interest payment was $100. Now, I didn't include a separate column for margin in here. What I did, I just reduced my guesstimate of total gain by about 1%. I'm saying that I'm going to earn 3.5%. So in reality, I'm expecting to earn a little bit more than 3.5%, but I'm subtracting a little bit for the margin cost. All right, so that's the projected side over here. Now, I already had the actual numbers coming for the first month. If we jump back to this slide, you see that my equity is 74,165, margin is 57,070, total 131,236. Let's go back to this Excel sheet. So these are where these numbers come from, 74,166. I rounded those off, and then 57,070, and this number's the same, 131,236. So the first month, my account grew by 5.95% for 1 month. So that's almost 6% per month. Now, remember that, I go back to this slide, I had 5 weekly payments this month because there's 5 Fridays. The QDTE, there was 5, pays every Friday. There's 5 Fridays this month. Next month, there's only going to be 4 Fridays, obviously. So we'll have the 4 weekly payouts and then the 1 monthly payout for the AIPI. That's why this percent is higher. Next month, I'm hoping for 4%. So I'm hoping this grows by about 3,000. So I'm looking at this to be about 77,000 next month. The margin will decrease. So every time I get a dividend, it goes toward paying down this margin. And when the margin gets paid down, decreases, what happens, the equity number goes up. So this number will go to 77,000 whatever next month probably. And then this will decrease by the equal amount down to like 54,000 or so. If I don't do anything except just let this go and don't add any money, don't do anything, this will grow and this will go down eventually to 0. However, I'm not going to do that. I don't know what rate or how fast or whatever. If you see my margin used, you see that my margin is going up each month. Before the margin falls down below 50,000, the balance over here, I will buy probably chunks of $5,000 worth of ETF. If I keep this over 50,000, the interest rate is like 0.5% lower per year. So it's just an even number. Rather than let this fall below 50,000, I'll keep that balance about 50,000, just keep borrowing and let that grow. Once again, people are going to say that's crazy and everything else. Right now, I'm starting out with a ratio about having 75% margin off of my total balance. In fact, over here, that's the formula I'm using. This number here is 75% of my equity, and it goes all the way down. This is 75% of this column. I may lower that at some point. This might be 65% of this amount. That will hurt my overall return, but that's okay. So let's go to the next slide. So this is my slide for my rental house. So this is pretending that I kept that house and I'm just collecting rent. So I don't owe any money, so I don't have a house payment. I didn't have a house payment on this house. We're starting out first of the month, 11/1/24. we're saying the house worth 70,000, so I have 70,000 equity. That's where I'm starting at. We're going to also say that I collected $700 rent first of the month, so that made rent and equity a total of 70,700. I'm going to calculate insurance and taxes by the month, just to keep better track. I mean, in real life, I paid annually for both of those in one chunk, but I want to break it out per month here. So insurance was getting close to $1,000 a year for this rental house, believe it or not. So I'm just gonna make it $80. That comes out to be like $960 for a year. That's close enough. The real estate taxes were about $2,400 a year. Illinois taxes are high, so $200 per month. And then something else I've done is because my ETF is growing, building equity based on the value per share going up a little bit each month, I'm also going to calculate equity growth for the house itself. So I'm going to say that the house is going to grow in equity 4% per year or 0.333% per month. So 0.333% of 70,000 is $233. So I'm going to add that over here. So I'm going to pretend that at the end of the first month, between equity and the value of the house and the rent I collected minus the debits, the first month is 70,653. So I think that's a fair comparison. So if we compare the two, so the rental house results, November, 70,653. ETF results for November, we ended up at 74,166. And total to date, ETF is ahead by $3,513. And these are the results I'm hoping for. Actually, these are a lot better than what I imagined. Remember, I had 5 weekly payments this month, so you take away $600, this would be around $2,900. That's what an average month might be, kind of shooting for 3.5% of 130,000 ish. So I'm looking at 3,000 per month as a goal. We'll see what happens. And like I said, what's going to happen in a couple months, I will buy like another 100 shares of EIPI, which has been earning 35% per year so far since the release of that ETF. So that's about 3% per month. So if I buy another 100 shares, that will be an extra $300 a month in growth. So if I do that every couple months, like I said, every time my margin gets close to 50,000, I'll buy another $5,000 worth of ETFs. Within a year, I may be buying as much as 100 shares every 2 months, maybe 600 shares. So you can see how this is going to really snowball if these returns keep rolling in like they are. Okay, that's the end of the video. I'll do this once a month and keep it updated. If you like this, I want to see how it goes. So good or bad, I'm going to stick with this for at least a year, maybe 2 years, see what happens. Keep making videos. If people like this, I'll just keep doing this as long as it's making money. If for some reason things go really south on me, I reserve the right to pull the plug on it and cash my money in and put it in the 2% CDs or something like that. So, okay, so don't forget to subscribe and like and give this video a thumbs up.